Hey there, Money Masters. Welcome back to another deep dive into the world of stocks, trends, and everything that makes that sweet ka-ching sound. Have you ever wondered what it was like right before the Great Depression hit? I mean, it's mind-blowing, right? How did things go from sky-high prosperity to rock-bottom devastation in the blink of an eye? I used to bug my grandpa about it endlessly, hoping for some magical insight into the mysteries of economics. But you know what? Understanding what happened back then might just help us navigate the stormy seas of today's economic landscape. So buckle up because we're about to uncover the secrets of what happens right before a depression starts. The boom and bust cycle theory. Picture this, we've got a tiny economy, just a handful of folks minding their own business. Then comes along the banker with a brilliant idea, lending money out of thin air. Suddenly, everyone's borrowing left, right, and center because hey, you can resist those super low interest rates, right? But here's the catch. All that borrowing creates a mirage of prosperity. People start feeling rich, spending like there's no tomorrow. But guess what? Tomorrow always comes. And when those loans start coming due, that's when the music stops, my friends. It's like a giant game of musical chairs, and when the music stops, someone's left without a seat. That's when the boom turns into a bust and the party's over. You know, it's kind of like buying stuff on credit cards. Sure, it feels great to swipe that plastic and live the high life, but sooner or later, that bill comes due, and if you can't pay up, well, let's just say the consequences aren't pretty. Rising debt levels. Here's another juicy sign that a depression might be lurking around the corner: soaring debt levels. Imagine piling on debt after debt until you're drowning in a sea of red ink. That's what happens when everyone, from individuals to big corporations, start borrowing like there's no tomorrow. And trust me, tomorrow always comes knocking. When debt becomes too heavy to bear, defaults start piling up like nobody's business. And that's when things start spiraling out of control. Think of it like a game of Jenga. You keep stacking those blocks higher and higher until crash. The whole thing comes tumbling down. And let me tell you, nobody wants to be around when that tower collapses. Declining consumer confidence. Now let's talk about a real game changer: consumer confidence. When folks start losing faith in the economy, they tighten their purse strings faster than you can say recession. Suddenly, everyone's hoarding their cash, afraid to spend a dime. And you know what happens next? The economy grinds to a screeching halt. It's like a chain reaction. Less spending leads to less production, which leads to fewer jobs, and before you know it, we're knee-deep in an economic quagmire. It's a bit like a self-fulfilling prophecy, don't you think? When everyone is convinced that times are tough, they start acting accordingly, and boom, the tough times become a self-fulfilling reality. Now, before we dive into the next set of warning signs, I want to take a quick breather and remind you to smash that like button if you're enjoying this deep dive into the world of economics and finance. Your support helps our channel grow and reach more aspiring investors like yourself. And while you're at it, don't forget to subscribe and hit the notification bell so you never miss out on our latest insights and analysis. Alright, now that we've got that out of the way, let's get back to uncovering the telltale signs of an impending economic downturn. Ready? Let's roll. Asset bubbles. Now, let's talk about asset bubbles. A fancy way of saying that certain investments have gotten way too inflated for their own good. It's like when everyone's rushing up to buy houses or stocks because they're convinced that prices will keep going up forever. But here's the thing. What goes up must come down, and when those bubbles inevitably burst, the fallout can be catastrophic. Just think back to the housing market crash of 2008, when home prices plummeted, leaving countless families underwater on their mortgages. Yeah, not pretty. Remember the dot-com bubble of the late 90s? People were throwing money at any company with a .com in its name, convinced that the internet was the future. spoiler alert, not every startup was the next Amazon or Google. When the bubble burst, billions of dollars evaporated overnight, leaving investors scratching their heads and nursing some serious losses. Unemployment spikes. Here's another red flag: skyrocketing unemployment rates. When businesses start laying off workers left and right, it's a surefire sign that the economy's in trouble. Suddenly, folks who were once gainfully employed find themselves out of work, struggling to make ends meet. And when millions of people are tightening their belts, you can bet that consumer spending, which, let's face it, drives the economy, takes a nosedive. It's a vicious cycle that's tough to break once it gets going. Just imagine waking up one morning to find out that your job's been outsourced or automated away. It's a gut-wrenching feeling, one that millions of Americans experienced during the Great Recession. And let me tell you, it's a lot harder to bounce back from a job loss when the whole economy's in the dumps. Stock market volatility. The stock market, where fortunes are made and lost in the blink of an eye. But when that roller coaster ride starts getting a little too wild for comfort, it might be time to buckle up and brace for impact. You see, wild swings in stock prices can be a sign of underlying instability in the economy. It's like the canary in the coal mine, warning us that trouble is brewing beneath the surface. And when investors start panicking and selling off their holdings en masse, it only exacerbates the situation, sending shockwaves through the entire financial system. Remember Black Monday in 1987, when the Dow Jones Industrial Average plummeted a jaw-dropping 22% in a single day? Yeah, that wasn't exactly a fun time for Wall Street. Or how about the flash crash of 2010, when automated trading algorithms went haywire and sent the market into a tailspin? It just goes to show that even the mightiest of markets aren't immune to sudden shocks and downturns. So there you have it, folks, 6 unmistakable signs that a depression might be lurking just around the corner. From the boom and bust cycle theory to stock market volatility, these red flags should serve as a wake-up call for anyone paying attention to the state of the economy. But hey, it's not all doom and gloom. By staying informed, being proactive, and preparing for the worst, we can better position ourselves to weather the storm and emerge stronger on the other side. So until next time, keep your eyes peeled, your wits sharp, and your investments diversified. Thanks for tuning in to Money Masters, where we're always one step ahead of the curve. Happy investing, and may your portfolios stay green in even the darkest of times.